Hey, Intro to Accounting, Mr. Roberts here, and today we're going to look at 7.2. This is one of the very last units that we are covering in this entire class. And today we're going to prepare a statement of owner's equity and a balance sheet. And yesterday, or previously in 7.1, we did the income statement. Now we're doing our statement of owner's equity and the balance sheet. And on the test, I kind of want to talk about the test for a second. Today we're going to prepare this statement of owner's equity. On the test, you're not going to prepare a statement of owner's equity, but what you're going to use is the owner's capital number that you calculate out in the statement of owner's equity. We're going to figure out what the new owner's capital number is, and you use that on the test. The thing is that you don't actually prepare a statement of owner's equity on the test, but what you kind of have to do is prepare one on a sheet of paper while you're doing the test. So you might get to the test and go, wait, there's no statement of owner's equity on here. Well, you kind of still need to know the steps in a statement of owner's equity to complete the test properly and correctly. And it will be the thing that somebody gets wrong on the test, okay? If there's going to be something wrong on the test, it's going to be our owner's capital when we're preparing our balance sheet because we didn't take into effect the statement of owner's equity. So I'm just trying to precursor this, that the statement of owner's equity, you'll do it on the homework today, but when it comes to the test, you won't actually do it, but you'll still need to know how to complete it. And in the real world, we're gonna complete an income statement. Okay, these financial statements are all integrated, is the thing, meaning they all work together. And the first way that they work together is we're going to complete an income statement. What do we get when we complete an income statement? Well, we get our net income. Then we're going to prepare a statement of owner's equity, and we're going to use that net income. Once we prepare this statement of owner's equity, we will have a new balance for our owner's capital. And then when we create the balance sheet, we use that new balance for the owner's capital. So it's all kind of tied together, and you would do these statements in that specific order in real life. You do a net income, statement of owner's equity, and then you would do a balance sheet. So we've looked at the definition of this already, but the statement of owner's equity is going to report any changes in the capital account over this specific financial period that we had. And it's going to show how these are the two things that it really is showing you. It's showing you how net income or net loss has affected capital, right? Because that's really the amount of money that we get to keep in the business or that we're losing in the business. And as Michael Delgado, your capital will be affected there, right? And then the other thing is the owner withdrawals. That's the other thing that we're going to use here. And the owner can take money out of the company whenever they want, but it is going to affect capital. So that's what we're going to look at. We're going to need to pull Michael Delgado's capital from our trial balance because that was our capital from the beginning of the month. We're going to need to look at the drawing account, and we're also going to use our net income. Once again, you can't do a statement of owner's equity until you calculate out the net income, meaning you would have already created your income statement. So let's move forward here. The heading of the statement of owner's equity is very similar to the income statement. We're going to put our company name, statement of owner's equity, and then for the month ended January 31st or whatever month you're in, it is showing that it is a report that is covering an entire fiscal period or the changes in a fiscal period. And here is our body of our owner's equity. Now this statement is really different compared to that income statement. It's just not, it's just formulated a little bit different, okay? And what we're going to have here is we're going to start with our beginning capital account. Now, where do we get this beginning capital? We go right to our worksheet and we go right to that trial balance. And what we're going to actually list is beginning capital. So here it says Michael Delgado capital, but then we're going to put the beginning of the month, whatever month that is, because this is the capital that we had on file on the first day of the month. Okay, on the first day of the month. So once we record that, we can record it on the second column there. Then what we're going to do is we're going to record our net income. So we record our net income there. This could be a net income or a net loss, but since it's a net income, it's going to be a positive number. After that, we go ahead and we write less Michael Delgado's drawing. So this is our owner's drawing account, because remember, we need to record any of that money that the owner took out. So what we're going to do next, and this is a little bit weird, right? Let me pull this up so you can see it even better. What we're going to do is we're going to use our net income and our drawing accounts, and we're going to find the difference between them. So what this is saying is we brought in $3,162 after all revenues and expenses were recorded, and we got a net income of $3,162. That's positively going to affect our capital, but Michael Delgado's drawing is going to negatively affect it. So we find the difference. So 3,162 minus the drawing of 1,150 is going to give us 2,012. So that's going to be our amount that we have here. Let me just pull this over to the side. Oop, not that. I want this. So you can see here that they found the difference, 3,162 minus the 1,150, and that's how they got the 2012. So is that 2012 a positive number or a negative number? Well, that's definitely going to be a positive number, right? Because net income is positively affecting our owner's equity. And that net income number was larger than the drawing, so it's a positive number. So what we do is we take that beginning capital of $2,000, and then we add the addition to our capital, which we just determined was 2012. What do we end up with? Well, now we end up with an ending capital, or here they write it Michael Delgado capital for January 31st, so the end of the fiscal period, and that new number is going to be 4,012. So that is our new capital number. We are going to use this new capital number when we write out our balance sheet. So it's very, very important that you know how we got to this new current capital. And like I said before, when it comes to the test, you're not going to fill out this sheet, okay? But what you do need to do is go to the trial balance, look and say, okay, what was Michael Delgado's capital? It was $2,000. What was the net income? Let me add that amount and then subtract the drawing account, and now I know what Michael Delgado's ending capital is. Obviously, these can change though, because this net income could be a net loss. So that would be something that you'd also look at, right? Because Michael Delgado's capital from the 1st to the 31st could go up or down, right? So just be aware of that. It all just depends. So those are the steps. Obviously, they're drawing lines underneath, showing that they're going to find the difference in total, and then the double line at the bottom. So we have all the things that we've had on these other statements pretty much. So then they kind of say, what happens if you have a net loss? Well, here we go. We have our capital account balance, and this would be on the 1st. We would say this is on the 1st is $6,000. Well, if we have a net loss, we're just going to subtract that amount, right? So it's going to be the $6,000 minus the $850. And then the drawing account is also negative. So what we're doing is it's $6,000 minus $850 minus the drawing account of $500, and then our new capital would be $4,650. This would mean that Michael Delgado's capital has gone down from the beginning of the month. Now, it's not good, right? There's a problem with our business at that point. And if you were Michael Delgado, I would probably be going, why did I lose money this month, right? What's going on here? Why did my capital go down? So that right there that we just looked at is going to be our statement of stockholders' equity, or excuse me, our statement of owner's equity. Our statement of owner's equity. So you need to know those steps. Next, we're going to prepare a balance sheet, okay? And if you look at a balance sheet, this is where our heading is going to be a little bit different. That's why I kept on pointing out for the month ended. A balance sheet reports the financial information on a specific date. So the end date of our fiscal period or our financial period is going to be when we record our balance sheet. It is a snapshot of a specific day, and it's going to show the financial condition of the business. And when they say financial condition, it just means like how financially sound they are. Do they have a good amount of assets compared to liabilities? Because a balance sheet is just that. It's the accounting equation. Assets equals liabilities plus our owner's equity. And we want to take a look and say, how strong is this business at this point in time? Is it something that maybe I want to invest in? Is it something that, maybe we need to, the business needs to be restructured? What does it kind of look like? If we go to Tesla here, remember we looked at their income statement? Well, what's the next statement that you could look at? The balance sheet. It's right next to it. And here you could go back, you can see the dates, and you can see a snapshot on 12/31 of all the assets and all the liabilities and all the equity that is in the company. So here, you can see that in 2016, the total assets, and I'm sure this is in millions, is we'll just say 22,664,000, and our liabilities is 17,125,990, and then our total equity is 5,538,86. And then you can see through time, like what happened in 2017. Well, it looks like they took on a bunch more liabilities, but they also built up a bunch more assets. What about 2018? Well, their liabilities pretty much stayed the same, but they increased their assets. Now we go to 2019, and you can see that their liabilities increased a little, but their assets also increased. So you can see the financial position for that company. I don't know if it'll exactly work, but because this financial statement's obviously a little bit more complex, but what's our accounting equation? Assets equals liabilities plus equity. So even a big company like Tesla, let's take our liabilities and add up our equity. 26,842, 000, this is 26 million, sorry about that, plus our equity of 7,467,000. 34,309. Does that match our assets? It absolutely does. Okay, it absolutely matches our assets. So even with big companies, the accounting equation still stands true. Assets equals liabilities plus our equity. So we can see the financial position of a company here. All right. So continuing on. Let's see, anything that we're missing? Not really. This must be taken from, obviously, like you could go in there and look at the general ledger and look at each account's balance, but we're going to put this together in a way that any stakeholder could understand it, okay? That they can go in there and understand it. So how is this heading of the balance sheet a little bit different? Well, if we look here, we put our company name, then we have balance sheet, but then it's just for the specific day of that report. That is how this differs. So it's not for the month ended or anything like that. It's just the last day in that fiscal period. Alrighty, assets and liabilities sections of a balance sheet. Just remember that your assets are going to equal our liabilities plus our owner's equity. And you're going to pull all the assets and all the liabilities and then our owner's equity, okay? And it's going to be our new owner's equity. The owner's equity from, in this case, it'd be January 31st. So, just remember, just like we were saying, the balance sheet is going to record all of our assets, liabilities, and then owner's equity. I'm going to kind of skip past this, though, because it's not exactly how we record it. In this class, we're usually going to record it just up and down. Pretty much like if we go back to like Tesla's, they kind of just, how do I say it? Like we're not going to, it's not super important that assets is on the left side here and liabilities and equity is on the right, the way that they have this. And it's just a little bit convoluted, right? What you want to make sure happens is that assets equals your liabilities and your owner's equity. And if we look over here, we have all of our assets listed. And remember when we talked about like headings, well, or total columns, like we have assets that's going to be listed up top as our heading, and then we have our total assets. So you add up all the assets. Then we have our liabilities. Liabilities is the heading. Then we have our total liabilities. Then we put in owner's equity. And we have Michael Delgado's capital. And remember, this is the new capital amount. And before, I know we've looked at drawing, and we usually put that underneath the equity account. But remember, drawing has already been used on the statement of owner's equity, right? We've already used that number, and we've come up with a new capital. So like that owner or the drawing account has already been kind of absorbed into our new capital account. So that's why when it comes down to this owner's equity and we have capital, we're not listing any drawing here. Okay, that's a very important point. At the end, what we're going to do is we're going to put total liabilities and owner's equity. We're going to add up the liabilities and we're going to add up the owner's equity, and it must match. Your assets must match your total liabilities and owner's equity. So this is a little bit of a convoluted sheet that just looks really messed up. But when we get into the homework, it's way more organized, okay? So with that being said, let's do it. Let's jump into the homework. Let's go into the working papers. And let's start it up. All right, All Pro Painters has completed its worksheet and income statement. It's now ready to prepare the balance sheet. First step in preparing a balance sheet is the heading. Fill in the blanks for each row of the balance sheet. Heading for All Pro Paints for April 30th. Okay. So we are calculating out a balance sheet here. So let's just put in All Pro Paint or All Pro Painters. It's going to be a balance sheet. And remember, this is just the date. So now it's just April 30, okay? April 30th, 20 dash. It's not for the month ended because this is just a snapshot of a specific day. So there we are. Next, let's look at the balance sheet items. The list of accounts shown here is taken from All Pro Painters. Figure out if it's on the balance sheet as an asset, liability, or owner's equity, or if it is neither. So we know that assets, liability, and equity will be on this balance sheet. So cash is an asset, petty cash is an asset, accounts receivable is an asset, supplies is an asset, prepaid insurance is an asset, accounts payable is a liability, but it's still on our balance sheet, right? Okay. Dwight Sunding Capital is capital. Now, drawing is not going to be on our balance sheet. So this is going to be under neither. Income summary is going to be under neither. Sales is our revenue, that's neither. And then all these expenses will also be neither. There we are. Calculate a statement of owner's equity. Okay, here we go. Let's pull this over here. And what we are going to look at is going to start with our capital for April 1st. So we're going to look at our trial balance, and our capital balance is $3,500. Okay. So remember, at the end of the month we make this adjustment, right? And you could even look at the balance sheet over here, the balance sheet credit. We're going to make an adjustment for this balance because this is from April 31st. Or excuse me, this is from April 1st, and we are going to calculate it for April 30th. So we're going to start with the $3,500. then we're going to put in our net income. Where can we find our net income? Well, we go right to the income statement, remember, and you can see here that we had more sales than we had expenses, and we had a net income of $3,730. Okay, it says right here, net income $3,730, and it's positive. Okay, I can tell that it's positive because it's listed under the debits. And if I just look here, I know that this is sales, and sales is $4,275, and here's my expenses, and it's $545. So I can just go, oh yeah, that's going to be positive. Let's look at the drawing. Okay, so drawing here, I'm going to look, my balance sheet debit, it's going to be $1,200. So this is less. Remember, this is less. We're taking our net income, which is the positive, right? Is going to be positively affecting our capital, and then the drawing will negatively affect our capital. So let's throw back up the calculator here. That doesn't look right. There we go. I say, what the heck? All right. So let's go ahead. 3730 minus, remember it's less, that drawing's negatively going to count it, or negatively going to affect our capital. So we have 2530. Let's go ahead and put 2530 in here. And now what we need to do is calculate out our new capital for April 30th. So we're going to take our old capital, 3,500, and this is a positive number, and it's 2530. So what do we get? Our new capital is 6,030. Now, what I would recommend is going ahead and writing this number down, okay? 6,030. I would go ahead and write it down because you're now gonna come across some stuff where it's gonna ask you for that number. So I would always write it down, and this right here is what you're gonna have to do on the test without this worksheet, without this little reminder. So you're gonna need to remember these steps. Take the beginning capital, add in net income. If it's a net loss, you'll have to subtract it, and then subtract our drawing, and then find the difference between that capital and our, if it's an increase or a decrease, to calculate out the new capital for the end of the month. Let's grade this step, and we are good to go. So now we're going to calculate out our balance sheet accounts. Let's go ahead, move this over again. Let me just pull this up and back down. Okay. Balance sheet accounts, and we're just transferring over this information, right? Same thing. So cash is $47.50. Petty cash was $75. Accounts receivable is, for Mackerman, is $825. Accounts receivable for Wu is $715. And we're just looking on this balance sheet over here, right? Supplies was $110. Make sure that you're taking the balance sheet number here, not the trial balance, or you take the wrong one. Prepaid insurance, $320. Because remember, this is a snapshot. This is a snapshot of April 30th. So if we would take the trial balance amounts, it would be a snapshot of the first day of the month, right? We've made all of our adjustments, so make sure that you're taking it off the balance sheet. Okay, so now we have our liabilities, and our liabilities is for Belmont. It's $275 and $490. And then what's our capital? Okay, well, if I would just go here and look at my capital, it's $3,500. Is that correct? No, it isn't. right? Because we just calculated it out and we found out that it was 6,030. Now, how did we get that? Remember, we take our capital, which was 3,500. We add or subtract our net income or net loss. Because it's a net income, we're going to add. So add 3,730 and then subtract the drawing. The drawing's 1,200. And we get 6,030. That is what you will have to do on the test, okay? That's why I keep bringing it up. I keep saying this is what you'll have to do on the test. All right, good to go here. And now we have our balance sheet totals. So we're going to take our assets. Okay, this is what it is all of our assets, our debits, and then all of our credits. We're going to add them up and make sure that they balance. So our debits, let's go ahead and add those up. 4,750 plus 75 plus 825 plus 715 plus 110 plus 320, 6795. Go over here and let's add up our liabilities plus our equity, right? That's the accounting equation. So 275 plus 490 plus 6030, 6795. We now know that our assets equals our liabilities plus equity. We can grade this final step and we are good to go. So I want you guys to get some practice in on this, okay? So make sure that you do the on your own. And then please make sure that you complete the application problem. And then I do have a randomized one in there. You only have to do the randomized one time, okay? Just one time, but I think this is important to kind of get. Now, that's it. That's 7-1 and 7-2. So if you can understand these concepts, understand the financial statements, what they're used for, and how to actually put them together, you will be in good shape for our second to last test that we have in this class. If you have any questions, please let me know.